I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers podcast show, and today we got a good update for you.
All right, we're going to talk about inflation. The reason why we talk about inflation so much is how it impacts our economy and more particularly interest rates. Also, this is a fun one. We're going to predict where we think rates are going to be in the next 12 months. And it's just not our word, but it's the professional's word. Also, where are interest rates today?
All right. So yesterday, inflation was reported, and we get these reports every month. So this was the September inflation, and we were expecting. Again, there's two different types of inflation that we really look at. We have core inflation and then the standard inflation. Core inflation is inflation without food or gas. The core inflation was 3.3%. It was expected or forecasted at 3.1, but the prior month it was 3.2. So it's a little bit higher. So inflation is being, if you take food and gas out, it's a little higher. Now, if we include food and gas, and the inflation number is 2.4. So if you hear people talking about inflation, they're going to say 2.4%. And that is a little higher than the expectations of 2.3, but it is lower than last month.
Yeah, at least it came down from the previous month, and they want to see something make sense.
That's right. And if we look at the itemization on the right side, this is the from September 2024 to September 23, what the inflation was for each item. So,
and we're basically saying a 0 is no inflation, no depreciation.
That's right.
If we see a 2, it means 2%.
Correct. That's right. So you can see there, all items, 2.4%. So that's just with all inflation. Food inflated 2.3%. That is what they're saying from the Census Bureau over the last 12 months. Now, I don't think that food is
it doesn't feel like that, does
only
it? 2.3%.
And again, this is what the government sends out to us. So we're just taking it. Now, energy. We see energy commodities and gasoline and fuel oil. It's like heating oil, especially if you live in, back east, somewhere in the north where it's cold. You're going to be using fuel oil. Anyway, 15% down in gasoline. Fuel prices over the last year down about 22%. So that's huge. And that's why core inflation is a bit higher.
And I think it's also important to note too, it's just not important for us at the gas pumps, but it's also, these are the same gas pumps that fill up the semi trucks and all the transportation vehicles that deliver our food, and deliver all the other things that we need. So it's just not our own personal things, but it's things that move things that we need.
Now, this is interesting. Used cars and trucks is down 5.1%. We had a big push of inflation with vehicles.
Yeah, right.
Down
used to make money. Who thought we'd be in a time where you could make money on a used vehicle?
And then shelter. That's basically all housing. That's rent, homes, whether you're purchasing or renting, shelter.
And right now,
4.9%.
Right now, I would argue that shelter is probably one of the biggest things that people are thinking about. So whether food comes down or energy comes down, they're still going to be saying my rent is really high and the home I want to buy is really high. So until that gets fixed, I think people are not even going to pay that much attention to the numbers above it. It's that important.
Yes. Okay, the 10-year yield. We look at this because the 10-year yield really affects mortgage rates. This chart is merely showing you what happened yesterday morning, which was the inflation update at 5:30 Arizona time. It basically, most of the time I see these charts go way up or way down, but this chart is showing actually not that much volatility. And as a result, I believe the market was ready for this report. And it's exactly what they were anticipating. So it didn't really react as much. So the 10-year yield is right where it basically began.
Right. Yeah. And if you're wondering, okay, how does inflation actually affect this? We were wanting, if we got a low inflation number, we would have seen that yield, that bond come down. If we see a higher inflation number, we would see a higher, yield, a higher bond. And that's what we're showing you. It literally was following inflation data that was coming out.
So when the 10-year yield goes down, mortgage rates go down. When it goes up, mortgage rates go up. So let's go to the next slide, which is our inflation bucket. Tom, what's the inflation bucket?
That's right. And we talked about this a lot, going back for the past year or two. And it's like being at the water park and you're sitting underneath that bucket that's filling up with water. You're looking up and you're looking up saying, when's it going to dump on me? The bucket represents really the market, the economy. And it's been getting stressed because of inflation. People are locked into their homes, not physically, but because all these low interest rates that they had from, 4 or 5 years ago, price of food and shelter and everything getting expensive. So the stress in this bucket, we're starting to fill. And what we kept saying is as the market starts to go over the edge, which will push interest rates down, that's really what it is. This bucket is getting full enough to where it's forcing the feds to do something to lower rates, which they did. But then when they did that, it was enough to make people think, well, things are okay. So inflation kind of got a little sticky.
Yeah.
So hopefully that kind of makes sense.
So you have to be it's a very difficult balancing act, or do you get with the bucket.
Right. And they talk about soft landing. Really the equivalent of the soft landing is how do we empty this bucket without it like tipping over and gushing out every single bit of, water it has. It just needs to pour it out slowly. That's
and the water
the idea.
Represents what again?
That is going to be the stress in the market. The stress, and what's adding to the stress is inflation, because inflation's starting to make everything too expensive. It's going to start slowing the market down, but yet the market can't handle being slowed down too quick.
Yep. All right. So this is from the CME Group, the Chicago Mercantile Exchange. These are the futures traders. This is how we're going to look at for the next 12 months. Where's the Fed rate going? Where do we think, or where do the professional traders think the Fed rate's going?
And where were we just 4 weeks ago?
We were right here on this right-hand column.
Well, we were actually, just one more over.
That's right. Okay. So we are in this column, the right-hand column. This is where we're at today. 2.5 weeks ago, the Fed lowered the rates 0.5%. And all of us probably know that, because maybe you remember 2.5 weeks ago, it was a big news. He hadn't lowered the rates when it was over 2 years. Over 2 years, because it was our first rate cut in over 2 years. So big deal. But we see right now we are in this column. And then these are the dates of the meetings, the Fed meetings. The Fed meets next November 7th. And there is an 85% chance that the Fed will cut 0.25%. By the December meeting, there is an 80% chance that he will do 0.5%. We'll have 0.5% additional rate cuts.
Okay, so some of the smartest investors in the world, these bond traders, are thinking we're going to go down 0.25% over the next 2 meetings.
Mm-hmm.
Okay.
And then if we look at going out 1 year, October 29th, 2025, that's the next meeting. Well, the meeting next year, the futures traders are expecting about a 58% chance that we will see not 1, 2, 3, 4, 5, 6. That's 6 quarter cuts, which would be 1.5%.
So basically a year from now, we have some of the smartest investors in the world saying we're going to either be at 1.25 lower or 1.5 lower. I mean, that's big.
That's right.
Look, there are no, percentages for anything less than that. No one. Those are all zeros.
Okay, so let's look at where interest rates are right now. And of course, interest rates for the 30-year fix, they hit a high in the last year of 8%. This is from the Mortgage News Daily. It's just taking a survey of all the interest rates in the country. This is not the Mortgage Brothers rates. Our rates are actually a bit more competitive, but the point is this is at least a survey. 30-year fix at 6.62%. The high was 8%. The 15-year fix is currently at 6.16, and the high was about 7.3% this year.
Yeah, and look at the 30-year FHA, 6.12. And what I want to show people, maybe people are looking at that, even though rates appear to be high today, I think people really have a psychological some damage because of where rates were. Look, They still feel like they're 8%, but they're not 8%. They're 6.5%. And FHA, they're not 7.5%. They're almost 6%.
Yeah.
Those are actually really, really good rates. Now we know that is a cup half full perspective because people are still waiting for them to come down. But in a vacuum, they still don't look bad.
All right, this is our last slide. I think is really important because a lot of people, well, the Fed's going to be lowering the rates another 1.5%. I'm just going to wait. I'm not going to do anything. Well, this shows the Fed cut the rate 0.5% 2.5 weeks ago. Okay, so when Jerome Powell announced the Fed rate cuts, they didn't go down 0.5%. They went up.
Yeah,
that was the low that day. They just started going up, and ever since they've been going up.
And the reason why we talk about these bond investors and how they're trading future contracts and whatnot is that, look, when they started to realize the Feds were going to cut rates, look at how the rates started dropping going back a month or two. So by the time it actually happened for the cut, that was old news. Yeah. They were already past that thinking, what's next? And what they were saying was, oh my goodness, they didn't cut by 0.25%. They cut by 0.5%. I wonder if they know something we don't know. A little more risk. And then it started pushing things back up.
So I do want to also just clarify the Fed and the Fed rate and the mortgage rates really are correlated, but on a very long-term perspective or long-term point of view. You have to be looking at the mortgage rates and Fed rate from a high distance to see that they're correlated. But when you look too close, day to day, week to week, they are not correlated at all. So in the next coming months or next year, we do think that rates have a potential to go down, but it won't be as fast as we think. So mortgage rates won't go down, potentially 1.5%. They may, but it's already built into the rates right now. So I just want to moderate people's expectations. Rates long term for the next 12, 24 months, likely down, but not as much as the Fed rate.
And we always talk about, rates coming, down or up. They're not in a smooth slide or in a smooth shoot. They are maybe the same thing, but point is it's a sawtooth. Yeah. It's going to be a little bit of a bump along the road. So, that's just the way it is. Nothing is straight in investing, and the bond is nothing different.
All right. If you have a loan scenario for us that you want the Mortgage Brothers to look at, be sure to email us or call us. We'll be happy to help you. And if you like what we're doing, be sure to subscribe, comment, and like, and we'll send you another update here very soon.
All right. Hey, thanks, folks.
Thank you for watching the Mortgage Brothers podcast. If you have any questions, email us at team@azmortgagebrothers.com. And if you like this content, be sure to like, comment, and subscribe to the Mortgage Brothers team.